In this video, we'll be talking about peer-to-peer lending. Firstly, let's understand what peer-to-peer lending or P2P lending actually means. P2P lending is a way for lenders and borrowers to conduct these transactions without going to a bank. The P2P website sets the rates and the terms of the transaction, and they act as middlemen. Here, your lenders are people who would want a slightly higher rate of interest than a savings bank or a certificate deposit or an FD rate, right? And your borrowers are people who would want better terms or a lower interest rate for the borrowings. Now, is all of this regulated? The answer is yes. Per a 2019 paper from the RBI, the regulator has set the maximum exposure of a lender to borrowers across P2P platforms at 50 lakhs, subject to their net worth. Furthermore, for any investment more than 10 lakhs, the lender must produce a certificate from a practicing CA proving that their net worth is more than 50 lakhs. In addition to this, they must also sign a declaration saying that they understand the risks and the P2P lending platforms would not be liable for any losses or NPAs that they might incur. Returns are, as always, based on the risks that you undertake. A lower rated borrower will have to pay more interest than a higher rated borrower, and a borrower who needs the money for a longer period of time will again have to pay more interest. There are two other aspects that you need to look for when thinking of returns. One is the default rate and two is the platform fees. Say for example, you make a return of 17% and your net default rate is at 5% and your platform fees are at 2%. This brings your net return down to 10%. And taxation on these assets is again classified as income from other sources and will be taxed at your slab rate, like any interest income that you might incur. The primary risk that you undertake with peer-to-peer lending is that of default risk. If your borrower defaults, it's game over for you and for your capital. But the question here is of judgment. See, with peer-to-peer lending, the risk evaluation is done by the P2P lending platforms themselves. Whereas for bank deposits and for bonds, they're done by the banks and multiple credit ratings agencies. Sure, they've made mistakes before, but ask yourself this question. Would you trust a technology platform to do your risk evaluation for you? Or would you trust large financial institutions with decades and some with even centuries of experience? Let us know the answer to this question in the comments and subscribe for more videos.